going to take a look at this Walmart bull put credit spread. I can't give direct advice on a stock, a particular stock and a particular strategy, but I'm going to show you how I would answer this question if it came through via email, during a coaching session, during the week, or even just a phone call. What would I look at first? All right, so let me navigate over to the PowerOptions suite of tools real quick, and we'll take a look there. There we go. I apologize. That was my fault. Aha! Much better. All right. There we go. So what we're looking at here is just the basic setup of the 14-day free trial. Those of you who just got started, I encourage you to go through the 4 steps here. Normally what I would do, if you asked me to look at a position or analyze a bull put, covered call, or whatever, I'd go right to the custom spread tool and I'd build a position on the fly. Since this email was sent in earlier this afternoon, I went ahead and put it into the portfolio. So let's go ahead and take a look. We're not going to see much movement. Here's a new portfolio. It's called Some Bull Puts. Here's the PHM position we were looking at a couple weeks ago when we were asked about the whipsaw effect on a bull put credit spread by Mark K. We're going to have full analysis on that position. You'll see that in the blog on Wednesday or Tuesday. But here's the Walmart position. Put it in as 10 contracts. Today, we would have sold the October 90 around 56 or 57 cents, bought the 87.50 for around 29 cents, and of course right now we're looking at a loss just due to the bid-ask spread and the slippage, but the return is going to be about 26 cents, as Khokon said, or to 27 in this case when I put it in natural prices, so about a 12.1. His is about an 11.6% return for the October series. Okay, well that's not bad. What would I do now? Whether I put this in the portfolio, if I put it in the custom spread, if you ask this question, I'm going to take a look at the profit and loss chart. Okay, so I don't know this stock. I know what Walmart is. I haven't been tracking this stock. I haven't been trading this stock. With my numbers, we see a 12.1% return. Let me knock a couple cents off of this here. And so Khokon is looking at 11.6% return as long as Walmart stays above 90 in the next roughly 41 days. 19th, 35 days, I apologize. So it's 35 days away. Okay, now, there's no talk about managing this position right now because it was just opened. It's doing kind of what we want in this scenario. Right? Standard bull put credit spread. Okay, now just going through some of the notes here. Here we go. Okay, good. We'll get to all those other questions, Rhajiv and Dawn, in just a moment. Now, what is my next step? Okay, now I didn't know what criteria you used to find this position in PowerOptions, what your search criteria was. I might have asked you that if we were on the phone. The first thing I'm going to do is take a look at the research tool next to the option of the stock. And I'm sure you didn't make this mistake, but the first thing I got to do is go to stock research. And I just want to make sure that earnings aren't coming up between now and October expiration. They're not. They're post. All right. So I'll look at the research tool. You can see if earnings are coming out or maybe a dividend, anything that might make you cause for a pause, lack of a better term, might cause you hesitation for entering this position. But everything here looks good. Now, the probability in this case, let me just go back to that research view again, but let me go to the option research. For our short put, the pivot point, the 90 put that we sold, here is all the data that we have for this particular option, including the IV over HV range, current implied volatility range, percent implied volatility range, and the probability. So we've got about an 80.5% probability Walmart will be above our 90 strike in 35 days. Okay, that all looks good. Last step to analyze this position. Now, this is the type of return I look for. Going 2 weeks out, 3 weeks out, I'm looking for around a 10-11% return. It's a 2.5 point spread. That's good. 26-cent net credit. That's fine. Risk is manageable depending on how many contracts you use in your portfolio size. What's the main thing, though? Let's take a look at the stock chart. So I'll just go to charts now, and we'll go to big charts. And of course, I have mine saved with looking at a 3-month chart. Got the 20-day moving average in there, Bollinger Bands, and MACD. I can't give you any direct advice on this position. As I mentioned, I haven't been tracking Walmart. I haven't been following its trading trends, anything like that. I can tell you personally, on my bull put credit spread search, this never would have shown up. I'm not saying it's a bad trade again because I don't know Walmart. I know your expectations, Khokon. You think the market's going to stabilize and it's going to be straightforward. I tend to follow the trend. I probably wouldn't look at a bull put credit spread if the stock's below the 20-day moving average. In fact, that's one of my filters. On the weekly bull puts in PowerOptions, one of the technicals is we only look for stocks that are trading above the SMA 20. This wouldn't have come in. I also only look for stocks where the MACD, the blue line, is above the signal line. Here it's reversed. I had a crossover about 7 days ago, and the RSI has been declining as well. I don't use RSI, but that's sort of a tertiary viewpoint. I don't think it's a major thing here, but the volume's also kind of holding or kind of decreasing. But that's, if you look at a trend long enough back, you'd say, oh, it's a major decrease in volume. Well, this was obviously earnings. Okay, that's where that spike occurred. But it's been pulling back since then. The Bollinger Bands are condensing, but it's moved just below the 20-day moving average. The MACD is below the signal line and dropping, and the RSI is dropping as well. I'm not saying it's going to drop to 90. I'm not going to say it's going to go back to this point here at 89 where it was trading before the earnings. What I'm saying is usually when I open a bullish or bearish position, I tend to follow the trend. This is not above the 20-day moving average. The MACD is not positive and moving up, and the RSI is not moving up. So to me, this would not appear on my search because the stock never would have matched it. I don't like to bottom feed. Okay, you could say, oh, well, down here you would have had a great position on a bull put. Maybe, and you're right. If it was 35 days out, 40 days out, even 50 days out, that would have been a good time. But I also could have entered it here and had the same result. Could have entered it here and had the same result. So I tend to look for those trends, those three technical indicators. I'm not saying this is a bad trade. All right. You asked me to analyze the position. This would be my analysis if you called up on the phone or during a coaching session. These are the 4 things I would go through right away. And to me, this wouldn't have matched my criteria. As always, though, make sure that you set a trigger point at about the 1% rule of your short option. So if the stock falls to $90.90 or maybe $91, you may want to consider management of your 90.87.5 bull put spread. Or you could just hold on and wait to see if it continues to decline, and if it falls closer to 90 or drops below 90 one morning, then you may look to manage the position in that fashion. So it's a good structure of a bull put spread. It is reasonably enough out of the money. It does have a good probability of about 80.5% of being above 90 in 35 days, 11.6% return. That's real good, 26 cents on a 250 spread. Maximum risk is really $2.24 per contract. I just would not have seen this one in my search because it's not above the 20-day moving average and the MACD is not positive. And that's what I look for in my bull puts. And you'll see that if we go to bull put credit on PowerOptions and we go into search, here we go. And this is on a 20-minute delayed account. All right, so the results come up. This is the weekly bull put default screen. There's only 10 results that are there. ServiceNow, AVGO, Adobe, Netflix. And if we go into the technicals, see here I'm forcing it for the stock to be above the 20-day moving average. And I want the MACD to be positive above the cross, MACD cross being positive of at least 3 days. Okay, so that's what worked for me in the testing. That's why the weekly bull put credit spread screens are there. And Walmart still might be a very good position. The return and the probability look good. As I mentioned, I wouldn't have seen it because it didn't match that criteria. All right, Rhajiv. He says, good afternoon. One observation. Market's not going up. Still, volatility is really low. How to identify a better volatility trade using PowerOptions? Condor, bull put credit, bear call credit. Simply screen for implied volatility, if that's what you want to use, but I don't think that's necessary to use. I think it's more important that you focus on a bull put credit, a bull call debit, or an iron condor that has the better probability, maybe above 85% or higher of expiring worthless, but still gives you the credit and still gives you the minimum return that you're looking for. Now, on a note, okay, let's look at two things very quickly on power options, and then I'll jump into the search for bull put and maybe iron condor. Let me go into the Learning Center underneath the main home tab. And I want to go to market activity. It's one of the links here in the Learning Center. And I want to look at Optionable Stock Statistics. This is a page where we show you sort of the averages across the market for things such as stock last price of all optionable stocks. The average price is $49.53, which is weird because the option bid price average is $16.73. It's kind of gets loopy when you throw all the vast numbers in. But yeah, so we have some of these numbers, but I look at this more importantly. Interestingly enough, the average earnings per share growth right now across all optionable stocks is 4%. Where am I going? The average implied volatility is 0.77. But notice how the 20-day volatility for stocks and the 50-day is at 0.29 or 0.33. I'd consider that low-ish, but not too low. Low to me is 0.15, 0.16, stocks like Johnson & Johnson, things of that nature that are more blue chip stocks. We'd like to see it a little bit higher. We have seen a little bit higher recently, 0.35, 0.38. But 50-day volatility of 0.33 is not that low. That's right around the average. But things are still moving kind of steadily. But I want you to keep in mind that the average implied volatility on all options is 0.77. There's some that are very, very high right now and some that are very, very low. And it's all over the map. And as a gauge, what does that mean? That means most options are actually considered overvalued right now across the market as an average. The average Black-Scholes ratio using the 20-day volatility, comparing the actual trading price of the option divided by its theoretical worth, is 1.72. The 50-day is 1.27. Okay, so that tells you the options themselves volatilities are higher than the stock volatilities right now. These volatilities 20, 50, 100, that's just for the stock. The implied volatility relates to the average options. And the average SIV, Stocks Implied Volatility Index range, which is the average of in-the-money and out-of-the-money calls and puts on every given stock for the next sort of 60 days, 45 days, is 1.02. It's higher. The nearer-term implied volatilities are much higher than the average implied volatility for all expirations going further out in time. Okay, so I go to Bull Put Credit, and I go to Search. Regardless of the market conditions, Rhajiv, regardless of how things are going in the market, as I just mentioned, if I'm opening new Bull Put Credit spreads on Monday, I'm going into this search. I'm pretty much using this as my default criteria from what's been tested. And do I have it up here? I'm sorry, I don't. Oh, I do. Okay, so these positions here, top 10, 12 positions, ranging in return from 7.3% for 14 days to 16.3%. Probabilities all above 85% based on my criteria. The short and the long option implied volatilities, highest one is 0.48 and 0.5109. And this is on, I apologize, let's get to that. Is that CAT? Yeah, oh no, it's Wayfair. I'm sorry, that's on Wayfair, okay? Now, I could simply change some criteria here and try to tell the system, I know the average implied volatility across the market is 0.77. I just looked that up. So you want to increase implied volatility. Well, you don't want to look for anything that's 0.77 at the average or higher. That's really high. As I mentioned, a good average is around 0.35, 0.36. So you might want to look for 0.40 or greater. But if I run that right now, based on the other criteria I'm looking for, things that don't have earnings come up between now and expiration, positive growth stocks, good average stock volume in an uptrend, and positive MACD crossover, I'm only going to get one result, aren't I? This is the only one that's going to stay. If you want more results with higher implied volatility, you're probably going to have to take out some of these because the good quality stocks in a good quality uptrend are going to have a lower risk. But all of these, Rhajiv, match my target goals for my trading plan This is on the lower end. I'd like to be in this range or higher. But all of these match that, have the probability I want, and the minimum net credit I want. Yours might be different, so you could just change that. That's the point of the search tool in any strategy. But you can simply use the implied volatilities to put in a higher number if you think that's going to help you. Remember, anything that has a higher implied volatility, here's sort of a catch on this. Let me take, what's my highest net credit? Wayfair, right? Yeah. So that's a good example. We see here that the higher implied volatilities have a higher net credit, almost double what we have here on AXP, which is a 0.17, 0.19 volatility. Here we are at 0.48 and 0.51, so we're almost double the net credit. That's what you'd expect to see. But remember, when doing any credit spread, if you're looking for an option that has higher implied volatility because you're hoping to collect more premium because it's higher valued, remember that the second option you're buying on the same stock with the same expiration is also going to be higher comparatively. Here we get a fantastic higher net credit on this position, but at the same time, why? What is it about Wayfair that has this increased implied volatility? And if I'm taking a bet on a neutral to bullish position, 135, 14 points out of the money, if I'm taking that kind of trade, I have to research why is this implied volatility almost triple of some of the other ones that came up in my list. What is going on with this stock? What is the past trading range of this stock that has that implied volatility increase? And this doesn't look that bad, but it's been moving up. But just remember, why does something have a higher implied volatility? It's because the market is expecting the stock to move more. It's a measure of fear, isn't it? A measure of risk. That means that the market is expecting this stock to move more over the next 10, 14, 20, or 30 days. What does that mean? Well, if I'm in a neutral to bullish position or a neutral to bearish position or a neutral position such as an iron condor, combining the bull put and the bear call, there's something in there that may cause me concern that I have to be very, very careful of. Okay? If it swings down unexpectedly, moves down 8 points, then drops another 3 points, then another 4 points, I'm at my strike price. Okay, I need to manage that position now. And because it has a higher implied volatility, it might move more. Again, it's a 5-point spread. Some of these are 3-point spreads, 2.5-point spreads. Sorry, I'm just looking to see if there's another 5 here. No, that's one of the reasons why you'd say, well, if the net credit is double, why is the return lower? And that's because this one happens to be a 5-point spread. And the Northrop Grumman one is a 5-point spread, and notice that net credit's there too. That's more of the reason why you're getting a better credit, because most of these are 2.5 or 3-point spreads. Here we have a 5-point spread, so the net credit is almost double the lowest, okay, which is a 3-point spread. That's what you'd expect. Okay, so Rhajiv, I hope that answers your question. You could just put in the implied volatility you want for the sell option or for the buy option to look for higher implied volatility. I don't look for higher implied volatility personally. I stay with my trading plan. All right, moving on now. Dawn says, on August 31st, I entered a vertical call spread on TLRY. We bought to open a 62.50 October at 8.89 and sold to open the 66.50 at 7.23. Okay, first things first. Let's build it in the custom spread tool to see what we're looking at. All right, so I just put, wow. Dawn, I'm going to put in my symbol first, TLRY, sorry. Let's go to October 19th. I'm assuming, did you say, oh, you said October 12th. My apologies. Few options for October 12th. Call spread 60, 250, 66.50. Okay. Add that. Shows me it's been added, 66.50. Buy at 8.89. Sell to 66.50. Far out in time. Bull call debit 7.23. All right, let's run that. Stock was at 65.08. Okay. December 12th, the stock was over 100. When I checked my account, it said I had a margin call. Okay, I'm going through this piecemeal. We had a margin call on the 650 part of the spread. Okay. All right. How often does this happen? Okay. In theory, you should not have gotten a margin call in this position. I know what happened, but you shouldn't have gotten a margin call. Regardless of the fact that you're in a spread, Dawn, and it's a good spread, it's done really well for you. You got to let me know what you did with this position because you probably might have done better if you could have avoided it, but I doubt it. Here we bought your 62.50 and sold the 650 call. You made a great play, speculation, 141% return. I really like it structurally. And you did it when the stock was right between the strike prices, essentially. Then you got this, oh, I'm sorry, folks, I bumped the microphone. Check that there. Then we got this massive push up, and it's continued to move up, and there's some decline today, was there not? Or was that yesterday? I can't remember. Let me take a look at the stock chart, see where we are. I'm going to answer your question, Dawn. Hold on. I just want to see where you are. Yeah, there it is. Today's the decline from 120 down to 109. Why did you get a margin call? Now, in my opinion, you shouldn't have gotten it. Here's why. If you had done a diagonal, Dawn, and this was a November 62.50, maybe I can see you getting assigned here early and your broker not exercising the long to cover the obligation of the short. I can see that. That has actually happened. 5 months ago, we had a conversation with a gentleman in a diagonal spread who was short near term. The stock ran up. They got assigned early on the short call. It was a double whammy. The reason why they got assigned early on the short call is that that day, 2 days before expiration of the short call, and he had a 2-month out long call in the money as a diagonal spread, Dawn, was because it was ex-dividend day. So not only did he get assigned, his broker didn't exercise the long to deliver the short, so now he's in a short stock position the day of the dividend, so he actually had to pay the dividend. His broker told him that they didn't exercise the long because it was a different expiration. What happened to you is that anyone who is in that 66.50 call, you're not one-to-one. You're not trading this with Joe, the option buyer. You sold X amount of calls at 66.50. Let's say you sold 10. Well, 5 of those might have been bought by Joe, the option buyer. 4 of those might have been bought by Mike, the option buyer, and 1 of those might have been bought by Cheryl, the option buyer. Right? It's not really a one-to-one ratio. All of the sold options and bought options are technically dumped into a pool, an open pool, the open interest, for lack of a better term. It's not really it, but this open pool. When the stock exceeded expectations of everyone in this group at the 66.50 call, when it started to get up to 100 or just jumped up to 100, they're out. They probably paid $7 for this, and it's now worth $35. Absolutely. Let me sell to close that call. Okay, but now what happens? The market maker, either real person or electronic in between, says, I've got 45 short calls sitting out here that aren't covered anymore because the people who were long the options all sold to close them. They didn't buy the stock. They didn't exercise those options. They cashed out. They made huge profits and cashed out, sold to close their options. But the market maker has to cover this. So what he does is he starts assigning shares short to the people who sold it at the 66.50. In a spread situation where they're the same expiration, rather than your broker, most brokers, I'd hope my broker would do this, and I know they do, most brokers would say, oh, geez, we've got a short shares of stock for you at 66.50 that are trading at 100. We've got to give her a margin call. They'd immediately say, no, this is part of a spread. We're going to buy 100 shares, 1,000 shares at 62.50. They're going to exercise your long to cover the short obligation so you don't have a margin call. Okay? Your broker apparently didn't do that, and I would call them and tell them that the next time you open a spread, they should make sure that they do that. Or how can you structure it so that they can do that? Okay? That I don't think should have happened to you. How often does it happen with a run like this? Remember, if I had sold a naked call, Dawn, didn't have the 62.50, but if I had sold a naked call on TLRY, I'd probably be in the same position as you, but I'd be destroyed. I mentioned if I was in a diagonal spread. If I had sold the 66.50 call when the stock was at 64, 65, and bought a 62.50 out to November or December, my broker might not have exercised the long to deliver the short. Now, that being said, if you got short the stock when it was at 100 and you said, oops, I don't want to be short stock, I'm getting a margin call, you could have just exercised the long to cover it. Would have bought shares of stock for you at 62.50, would have covered that. You would have gotten the 4-point difference now at maximum profit, which you might have done, of course. However, we saw here on the chart that eventually it went up to 120. So if you, now you still would have made the same amount. I'm sorry. Yeah, if you would have covered the short at 100 and then it went up to 120, you would have got 20 more points of intrinsic value on the long call. But you would have had to pay the money at $100 per share to close the short and then kept the long so it can keep going. But yeah, how often does it happen? It's hard to tell. Okay, I don't have the numbers on how often early assignment happens. I do think that you should not have gotten a margin call, that your broker should have seen that and exercised the 62.50 to cover your obligation at 66.50, not left you short stock and given you a margin call. As we did before, in any conversation, when I don't know something, I'll check out the stock research tool. This stock doesn't pay a dividend. I was thinking maybe we crossed the next dividend date and that's why you were assigned early in addition to stock being up 100, but it was clearly just from the movement of the stock. Those who bought the 66.50 calls for that expiration more than exceeded their profit expectations, cashed out, moved on, but the market maker has to cover the difference in between it. He can't have pools of things sitting there as well. So that's why I should have been exercised there, okay? Oh, okay, so Dawn goes on to continue. As I ramble on here, Dawn comments into us and tells us that is what happened. Like you said, she did get the margin call, but then it was exercised here, the 62.50. It was covered. The main question is, why did it happen? It's because the growth was so astronomical, Dawn. That's really what it was. Think about this. At the time when you got assigned, let me take a look back at the chart here. It was around, you said I think it was around 100 here. So let's go to September 7th, September 8th. Let's just go to the chain historically. Oh, I'm sorry. Let's go to the historical chain for September 7th to September 8th, that time frame. Maybe I'll go to the 10th. Maybe it's closer to there, but let's look at the chain here. We're at 110 right now. Oh, no, it was after that. I'm sorry. So let's move forward a couple days. 84.50. It's probably closer to the 13th, and I think you even said the 12th, if I'm not mistaken. 95.79. 104.95. Okay, so around this time frame, the 12th. Okay. October 12th weekly. I have to go to the large chain. The 66.50 call, right about where I said, about $37, right? 36 bid, 39.80 ask. Let's just call it $38, okay? Now, let's say that someone did buy that call the same time around you did. They bought the 66.50, not as part of a spread, not as the opposite bear call credit spread to your bull call debit. They just bought calls here. Anyone who probably bought calls here paid about $7.20, $7. They've made $31 on a $7 investment. That's probably their target. You know, it blew through their expectations, more than doubled, and they said, well, let's hold on. Someone out there probably had a target price of 102 or 103, and they were waiting for it to hit it, and it did, and they have a massive return, okay? Massive return. $7 to $37, rough $38, $31 profit on a $7 investment. Good stuff. So they cashed out. But the market, across all expirations, near term, short term, long term, would have taken all of that out, okay? So that's what we're looking at there, and that's what happened, okay? Sorry, I'm going to go through some things here real quick. So on these comments, Sam has been throwing stuff at me the entire time, and I just got to reading them. So Sam says hi to everyone in the room at 6:50 a.m. He's out in Australia this week. He had a fantastic week. He's just going to tell us what. There it is. Facebook, TLRY. I keep saying that wrong. I'm sorry. Big move and options called, paid for the trip. Okay, so it was Sam's fault. I apologize there, Dawn. Sam says he should have bought, would have bought 70 calls as well. The broker will sign because the stock is too volatile and risky. Yeah, so that's what happened. I was just joking. I was saying it was Sam's fault because he said he bought calls on TLRY as well as Facebook and cashed them out, and that paid for his trip to Australia. So, Don, it's Sam's fault. He probably had the 6650s, the 6750s, the 70s, the 80s, and the 90s, and he sold them all out, so that's why you got assigned early. Of course, I'm kidding, but that's just, you both made money on the position, so we can kind of joke about that. And Sam had a similar situation. That's interesting. We keep seeing this. Sam had CGC, very similar patterns and similar sector, industry, right? If I'm not mistaken. The CGC, Sam was talking about this back in June and July, back in August and June, and he had the rocket ship here from about 30 to 55-ish, 54-ish, somewhere in that range. But he did have a spread at one point. He said he got called by the broker. He told me he'll have to close the position even if he had a spread because of the volatile nature of the stock. And so that's what got it there. Okay. All right. Okay, Martin, I'm going to get to your question in a second. Rhajiv, I'm going to get to your question. Just 1 minute. Sam bought the 90 calls on TLRI on Wednesday, paid $5 and got out yesterday with $115. $25 was the best trade in some time. Yeah. I saw it in the news too. I just didn't go there with that one. Okay. Martin says, how do I get to the getting started page with 4 steps? Okay, so let's go back. This is when I first logged on. Now, Martin, I want you to remember that this is a trial account. My webinar account we set up on a trial. William Adama has 12 days left on his 14-day free trial to PowerOptions. And so whenever you log on to your trial account, you'll see the 4 steps. Get the quick start guide, free flash tutorials, access the recorded webinars. Here, if I just click free webinar, whoops, sorry, forget it does that. It links you to the last recorded webinar, and then the free coaching session. Martin, if you're currently a subscriber, if anyone's currently a subscriber, can you still access these? Absolutely. First thing, go to Learning Center. Quick start guide right there. Schedule the coaching session. You can review the tip sheets. The flash tutorials, Martin, are listed here as well. So if you once you subscribe, those 4 steps are gone, but just go to the Learning Center. Got the quick start guide, sign up for a coaching session, got the tutorials, webinars, strategy help pages, archive of the Price Watch Alert morning updates, and then that market activity link and more that I showed you. What's missing from this, from the 4 steps? The only thing that's missing is the flash tutorials, start guide, free coaching session, free webinars. It's all there in the Learning Center menu. So if you subscribed, the steps disappear, but you can always access them and more information, Martin, just under that Learning Center tab. Okay. All right, and I think I answered this question ahead of time, but Rhajiv did pop this question in here for us. And when we were talking about the Walmart, he says, when should we start managing that Walmart position? We'll wait till what point? Walmart's down due to the Costco downgrade today. It may recover on Monday. You're absolutely right. Yeah, that's something that when I mentioned looking at Khokon's position, the Walmart spread, that I said it wouldn't have come up in my search for my criteria. That doesn't mean it's a bad trade. Rhajiv gave us some insight that, by the way, I would have looked at too when I analyze your position. I also would have gone to the news, see what is there anything recent out there that may give me some insight into the recent decline or why the MACD is negative, okay? But one thing I would have done had I followed that next step is possibly seen that Costco was downgraded. It would have had an effect on Walmart. Similar sector, similar industry. But it could rebound, of course. And as Khokon said, he knows this position. He knows Walmart, the stock. He knows the trends of this position, which is why he felt comfortable with this spread. And there's nothing I fear to be wrong with that at all. This is a good structured bull put credit spread. A little bit more time than I'd like to see, but you went with the more time to get the return you needed. So it's acceptable and it's good. It looks good. I'm just stating why it wouldn't have come up in my search. When I analyze a position, I tell you what I see. That's what I saw and saw it as a concern, Rhajiv. But you're absolutely right. Could come right back up on Monday, go back up to 95, 95.50, maybe a little bit more, gain some back, depending, of course, what happens over the weekend. some bad news could come out over the weekend and the whole market could be pulled down a little bit on Monday and then wait an extra few days to recover. We've got time on this one. But as I mentioned, and we talked about it last week, Rhajiv, sorry, but to answer your question directly, my stop for a 25-day trade or more, a spread that's 20 days or more out of time, is usually about 1 to 1.5% of the short option strike price. I sold the 90, so my target's going to be here. The stock falls to $90.90. That's when I may look to manage the position. Okay, now, secondary thought on that. That's that's usually in a gradual market. If it opens up Monday at 90.90, I may or may not manage it. Why? Because I've only been in the trade for 1 day. What's going to happen if this stock falls to $90.90 or $91 at the open on Monday? The implied volatilities are going to spike. Right? They're going to spike up, which means the buyback cost for this is going to be ridiculous. This will go up too to help me maneuver the spread, close out of the spread, roll it down, the 7 ways we talked about last week, which we're going to review next week during a Wednesday presentation, 7 ways to manage a bull put bear call spread. Okay. That's always tough when it falls that fast, that quickly, because now the implied volatilities are kind of messing you up. But the good thing is with that fall is that even though your implied volatilities are increasing, the implied volatilities of options further out in time that you might roll to at lower strikes are also increasing, so you may still be able to manage it, or you may be able to easily convert it now, depending on what happens, to a bear put debit spread with just moving the long put in that case, the pendulum adjustment. But I usually wait for the stock to be between the strike prices before attempting that maneuver, and that's usually when I get the best prices on that as well. All right. So yeah, that was what I was referring to, the 90-90. Well, we touched about this last week a little bit, and I talked about the trigger points. I had a more in-depth conversation with someone, a coaching session, I apologize, a coaching session this week on credit spreads. And one of the things the customer asked me during the coaching session is that, well, if I'm setting up these spreads, other than the ways to manage it, how would I know when to manage it? Okay, should I use the stock price? Should I use the credit as a role? Whatever, what should you use? Okay, now the 4 things I'll tell you that I use as my trigger points, which are described in the full webinar on managing your spread positions, talking about credit and debit spreads. We already looked at the bull put weekly search, and we saw that there were factors that were being used where you want the stock to be above the SMA 20. For the technicals, I wanted the stock to have a positive MACD crossover. I wanted a probability of 85% or higher. Okay, now I could get better credit with, looking for 75 or 80% or higher, but this matched my trading plans. That's my probability of that as well. And, on average, we saw the net credits for a 2.5, 3-point spread were around 25 cents, 24 cents. Okay. So the factors that I use as a trigger point for my spreads. First one is stock price. The stock reaches within 1 or 1.5%. Now, this is for a 20-day trade or further, 3 weeks out or more. It's usually about 1 to 1.5%. If I'm in a 7 to 14-day trade, and normally I'm around 14, it's usually more of a 0.5 to 0.75% of my short option strike price. I know it sounds strange, but I want to give it a little bit more room to fall because I started with lower net credit. Now, why the stock price? Because this is my pivot point. This strike that I know is 90, and what's going to affect whether it's close to it or away from it, what's the stock price? So that's my pivot point. When that becomes threatened, that's when I look to make an adjustment. Opposite on the bear call side, of course. So within 1% to maybe 0.5% of my short put strike, that's when I might consider a trigger point, when I might consider management. And number 2, any of these technicals reverse. If the stock now drops below the SMA 20, it's been declining a little bit, but now it moves below the 20-day, or I see a negative MACD crossover and a weakening RSI as sort of a third confirming trend, that's my second trigger, because I wouldn't open a bull put spread if the stock wasn't trading above the 20-day moving average or it had a negative MACD. So I'm probably not going to stay in a bull put credit spread if the stocks now move below the 20-day moving average and below the MACD, depending on how much time is left. If it's 1 day left and it just had a recent crossover, I may stay in it for the next 24 hours to see if I get the full return. But if the stock drops and goes below the 20-day moving average 3 days after I enter the trade and then hits a negative MACD 4 days after the trade and I still have 10 days left, I'm probably considering managing that position. Number 3. I may use the probability. So if the probability drops below 70%, really probably below 65%, that's my other trigger point. Those of you who use delta, this equates almost to a delta of 0.2 on the short option or 0.15. So you might say, well, if my delta doubles and moves up to 0.4, 60% probability, or if it doubles to 0.3, 70% probability, that's when you might exit the position, because you wouldn't have opened the position if the delta was 0.4 or 0.45, so you might not want to stay in the position. What do I not use? Those are anything that I use as a technical, and if you use other things, if you use stochastics as a filter for when you get into a spread, you only enter a bull put credit spread if you see a stochastic that matches your bullish criteria, okay, a bullish stochastic setting. Well, if that stochastic turns bearish, that would probably be your trigger point to consider adjusting or exiting the position, because it's now gone the other way, right? It was bullish when you opened it, but now it's not. You don't want to stay in it, or you want to turn the bull into a bear. What do I not use? I don't use the net credit, okay, meaning I received 27 cents of net credit for this spread. I know there's some of you out there who do this, and you've done it well. And this is personal preference, but why don't I do it? Some of you might be using this field that if the debit to close the position, to buy to close the 90 and sell to close the 87.50 is 2 times the initial net credit, 54 cents, or maybe 3 times the net credit, 71 cents roughly, you might close the position. So this loss you take would only wipe out 3 trades rather than if it kept going and you took the full loss. Remember, with a net credit of 27 cents, this might have wiped out 9 trades. So you're trying to minimize this win-loss ratio. That's good. We're all trying to do that. We all hope to do that. But the reason why I don't like this is because if I am in this trade in Walmart, Costco just got downgraded today. Let's say Big Lots, I know it's not exactly the same, but let's just use a reference. Big Lots and Ollie's Bargain Outlets gets downgraded on Monday. Well, Walmart might take another hit, but at the same time, what's that going to do? It's going to increase the implied volatility. But let's say that news comes out, Walmart stays at 94.59, but the implied volatilities move up because of the fear that they're going to get downgraded too. What happens? These two option premiums increase and the bid-ask spread gets wider, and the midpoint price might trigger my exit even though the stock is still around the same price. The stock didn't move. The technicals are still there. Well, they're not there in this case, but the technicals are still there. It's still got a positive MACD. It still has a position there as well. I'm sorry, it still has positive MACD. It still is above the 20-day moving average and so forth. But I've hit my exit because implied volatility and fear on the market triggered. And if the implied volatility goes back and the stock stays normal, I'll still have a profit, okay? Hold on here, folks. I'm going to scroll through this real quick. Okay, it's just Sam said, I'm in Twitter managing my short puts, rolled 3 times. I have 5 weeks, so you're playing around the 30 now. Okay, you're playing around 30 delta, I think is what you mean. All right. Mark, going back to the bull put credit spread discussion, just one moment. You can see them all right there. I'm sorry, Mark says, what is your 4th item on your personal criteria guide to bull put credit spread? Stock above the 20-day moving average, positive MACD crossover, 85% profit. Number 4, I think I said it was around at least an 8.5% return. But let's take a look. I'll show you exactly what it is. Remember, you can see it at any time. This is exactly what I use, by the way. This is sort of, I haven't put the effort in to have this be called a pick of the day. Okay, in covered calls, we have the weekly picks of the day and the monthly. In naked puts, we have weekly picks of the day and monthly that Ernie tested. This is what I've tested, and this is what I use in my personal account. Okay, I use this search, the weekly bull puts in this time frame. Net credit is not important. 85% probability, we talked about. Range out of the money 3, that's fine. Not between now and expiration. Earnings, that's probably the most important one I mentioned. Mark, for that, I don't want any earnings between now and expiration. But the technicals, I am just using stock price above the 20-day, MACD crossover 3. RSI is something I use as a eyeball, okay? Usually only when I'm managing it. If I see that my MACD has been negative and then the RSI is pulling down as well, that's sort of a confirming factor. But the 4 things to do with the stock is stock above the 20-day moving average, MACD crossover. I do want 85% probability. The return has to make sense. The net credit and the return has to make sense for my trading plan. But yes, I am avoiding any stocks that have an earnings between now and expiration. Any credit spread, vertical spread, I'm doing that, okay? Even my diagonal spreads, my calendar spreads, I always check that box so there's not earnings between now and the short option expiration. I don't want any sudden surprises on the first or second right of my diagonal calendar spreads, okay? But that's everything you're seeing right there. Now, I prefer a strike difference of $2 or more. That's personal preference. Why? Let me see. Do I have a good 2 or 3 point spread here? These are 2.5, so it's not really as close as I want. I'd probably do a 5 point spread there. Okay, here's an example. Tableau software 108, 105. Why is that important? Well, because it tells me it has single option strike differences. Why is that important? Because as we talked last week, if the stock does hit my price of around 109.80, 109.50, 1%, 0.75%, stock drops to this, one of the management techniques I may use is I'm in the 108, 105. Stocks drop down to 109. What was the reason for the decline? Was it market-wide or was it systemic to this stock? Bad news came out, poor earnings are planned, then I might want to get out of it or turn it into a bearish position. But if it's just a market-wide drag down and it's been a slow market and it's been pulling down, but this stock is still good, what I may do is buy to close my 108 and maybe sell to open the 107 or the 106. I want the opportunity to be able to move down another strike without moving the long as one of my potential adjustments, okay? So I do prefer to look at spreads that are 2 points apart or more so that I have the opportunity to roll down one strike without adjusting it, okay? So that's one of the things there as well that could also be considered. Sam throws this out there in relation to CGC and TLRY, that CRONS is another one that's lagging. The 9 to 12 range there, but he's been doing spreads on that in the near term also. Okay. Okay, Sam here, another comment. Whoops, Twitter. He had 35 puts and kept on selling 32, 30, 29 puts. You're not making money on the short puts. This relates back to Rhajiv's comment about maybe lower volatility. So you bought 5 puts at 32 as well, and you had the back ratio spread. Okay, so yeah, you're converting. You started with a spread, or you started with a long put, and then you converted it. Okay. Okay. Rhajiv has a question about an Intel married put. I don't have the numbers. Maybe I do. Let's take a look. See if I thought I had done it at one point, but let's go into the portfolios here. So we're talking about RadioActive Trades, the married put position with the 12 different income methods for controlled risk. And I didn't put Intel in here. Did I put it in another one? Some bold puts, May 25th, rolls and adjustments. Married put compare? Did I lump it in here? No. No, I did not. No. Okay, in any case, what Sam is asking, what Rhajiv is asking is an alternative to one of the income methods, okay? And let's just say we've got a November put out there. Let's say we've got a cost basis of 100 shares of 38. On the stock at 45, let's say at one point we had, sorry folks, there we go, 38. Say at one point we had bought a 44 put for 44, $6. Let's say we got it later. No, let's say 720. I know it looks weird, but let's just do that. The actual spread doesn't matter. Okay, now stock's at 45.54. This is our path from Intel. Oh, it's reversed. I might have bought it at 50 and had the higher strike put. Okay, so it's declining. Now it's tapering off here a little bit, hit the bottom near 44, came back up above the Bollinger Band. Don't know if it's really showing a positive trend. Don't have a crossover yet, and the RSI flattened out. But the question is, if it does recover, could I do an adjustment where I could sell at and buy 2 higher or 3 higher? So I'm going to go back here to November. I'm going to say the 55 put, and we paid, let's say, $720 for it. That's going to be our married put. So I bought stock at 50, paid $720 for the put, max risk of 3.8%. Sorry. And the stock has been declining ever since. Okay? Now, normally, what I would do with an income method number 5 is a standard ratio call spread inside the married put. I'd buy a lower strike and sell 2 higher to try to get a credit. The credit reduces the monetary value, reduces the maximum risk, and if it goes up, I sort of have a bull call debit that I make a profit on 2 points or 3 points apart, plus the net credit, so I might be able to bulletproof this position if it works out exactly right. Sam's expecting, sorry guys, Rhajiv is expecting more of a recovery. So rather than buying 1 lower and selling 2 higher, we want to sell a sort of at the money 46 call and buy 2 higher strike calls. So I'm going to reverse this idea by selling 1 and buying 2. So now the 100 shares might be covered by this short call, but we're going to use the premium received at 46 to fund the 48 calls. Okay? So it's actually a bear call credit spread now on a stock you think is going to go up with an extra long call. So here you still get a credit. You sold the at the money at 46 and you bought the 2 out of the monies for about $40. Let's call it $78 and $40. So you got a 38-cent net credit. Why does the risk increase? Because when the stock's trading right at 48, if it moves back up to $48 in this case, you get assigned here at the short call of 46 when your cost basis in the entire married put is 56.81. Okay, so you get assigned here on your 100 shares and that's out. As the stock continues to move up, what's happening? Well, at this point, you still have 0 value in these 48 calls. They're not in the money yet. And your put is declining in value as the stock continues to go up. You no longer have positive delta until you reach this upper break even at a much higher price, looks like around 51.46. Okay, so if you really think it's going to recover 6 points, I know this might not be the structure you're using, but we sold the at the money, we bought 2 further out of the monies, but now your break even up here is wide, and the risk increased in that chance that if the stock does end up trading right at 48, you have no more positive delta here on the stock, these go to 0, and your put is losing value. So we took that, we doubled the risk from 3.8 to 6.7 in this range if the stock's trading right at 48. Probably not going to be trading right at 48, but again, that's just to give you a visual. And this break even moves way up. Now, if you expect it to recover and you've got a low risk on the position, remember this number, 51.46, with this selling the at the money, buying 2 out of the money, and still getting a credit, break even of 51.46 on October 5th. That's important, okay? Let's go back to the standard married put that we had, even with a stock at 55, well below our strike. Break even at 57.20 at November expiration. Okay? What would happen here if the stock was trading at 51.46 on October 5th? We're going to be at a loss. I can tell that. We're not going to be at break even. Yes, you're still going to be at a loss of 183. So that would help. But you're talking about 6 points movement over a 10% increase in a 2 to 3 week period. You get that check mark and you actually double the risk if it's in the middle. Okay, so that's my thoughts there on that, Rhajiv. That's why I don't like to do it in that case. Okay. Oh, Rhajiv, no. I'm sorry, I don't mean to be mean, Rhajiv. Rhajiv says do the 46 and the 46.50. You can do that on your own on the tools. I personally never do a 50-point spread of any kind, whether it's bear call, whether it's bull put. This was another conversation I had during a coaching session. We were looking at one of the trades, and a customer was talking about a regular, now there are no 50 strikes here unless I go to, what did you say, November? Yeah, there are no 50 strikes here. 50-cent strike differences, are they closer? Oh, you got to go to September 28th for the 50-cent strikes. 46 and 50, buy one, sell one, buy two. This doesn't look like a credit. Okay, it's closer though, so the break even might be lower. Yeah, 58 to 39 here, so you're spending 78. You're 20-cent debit, 4.2. Yeah, it's so close to the 50 cents. You're right. It lowers the break even to 49.33. But I don't do these 50-cent ones with a standard income method number 5. A customer asked me why. Well, we were looking at a standard one. Remember that I'd reverse, which would be buying one and selling two of the higher. Okay, so now I get 78 cents. I get a 20-cent net credit. But now that bull call debit aspect of this trade, yes, you wouldn't do this, I know. Remember, I bought 146 and sold 246.50, so it's like a covered call. One of these contracts is combined with the 100 shares and a bull call spread. I get a little bit under a 20-cent net credit for this income method number 5, and then I get 50 cents if it's between it. So I get 70 cents net credit at that point. Okay, this one I might do. The reason why I mentioned it is the example we were looking at Sony and the stock that the customer had, the net credit was 10 cents to get 50 cents. So they were going to get 60 cents, but just selling the 46 by itself instead of buying it was 75. And just selling this one instead of buying it was 33. All right, so it's about 66 cents in, so like 75 cents out. So if they had just done it straight away with a 50-cent increase by just selling the call, it actually looked better than the income method number 5. If the stock stayed neutral or stayed right at 46 or even at 46.50. Again, each stock's a little bit different. So Sam, Rhajiv, don't necessarily trade how I trade. I'm telling you why I never look at the 50-cent strike differences. This is a question for you, not for me. You can plug this into the chart and see it. Does this match your goals for the trade? Did it lower your risk enough? Do you expect the stock to move up 4 points, roughly 10%, in the next 21 days? Not even, 14 days, so that you'd be at that break even of 49.33. Or if you think that's your target, is it better to wait till the stock goes back up to 49, gets closer to 49 or 49.15, and then evaluate your income methods after the move? Okay. Yeah, and Sam's just, he's not selling for them, but Sam's just mentioning that a lot of the reasons why he's been doing, been using Robinhood recently is the Robinhood Gold platform has no commissions for spreads for rolling in and out, which really saves him a lot of premium, and concern with adjusting and managing spreads. He feels safer managing spreads now with the no commissions. He says the fills are fast and smooth, and he hasn't had any issues. Sam says, just to Rhajiv, he says he got out of Intel a few weeks ago and got into AMD. So that looked like a good move if you're bullish, of course, selling out of the calls of Intel and then moving them into AMD because they've had a nice, good run there as well. Okay. So Rhajiv, I'm not trying to be rude to you. I see the benefit of what you're trying to do. It's not something I personally do. That doesn't mean it's bad. But remember, target your break even. And if you feel really strongly that the stock has this chance to recover to 49.33 at that time, you'd be at break even, but then you can also consider maybe it's okay to wait for the stock to get to your target price you think in 14 days and see what better income methods, better adjustments are available now that the stock is back up to near your original purchase price on the position. Okay, so just a thought. Just that there is a risk of over trading in any strategy, even this one, going forward. So yeah, you'd still be at a loss here, and I don't know if you have the November, I forget because I chose a short term, but if you are shorter term, then yeah, you want to start managing it faster. But again, depending on what your outlook is and if that's your target, you should still do pretty good if in 14 days the stock hits there, and then you look at new income methods, or if you guess it right. Oh, you're out to January. Okay, that's good. That's real good, Rhajiv. I don't know why. I know we were talking about Intel a few months ago. I can't remember if you started in January or if you rolled out to the January, so that's why I always forget that. I don't know if, let me check. Mark J was on the line, but Mark K from a few weeks ago is not on the line, I don't think. Yeah, so a couple weeks ago, I remember when we were on the 2 weeks ago on September 7th, Mark K had asked about the whipsawing effect on bull put credit spreads, and we use an example of PHM selling the 27 on August 20th and buying the 25 for today's expiration. And what might we have done? Now, on that day, on the 7th, Friday's close, the stock, I believe, was at 26.96, so it had just breached below my 1% rule. It had opened at 27.40, and then it dropped down to 26.96, so it had breached that. We still had 2 weeks to go to expiration. I said I'd wait to see what happened on Monday. Of course, what happened on Monday, this isn't a real trade. We were just using this as an example. The following Monday, on the 10th, the stock did open back up. It had pulled down, then it opened back up. You see here, let's just go to one month here. Let's go 5 days. That's going to be better, isn't it? Here we go. Oh, no, that's not better. Let's go hourly. How about that? Okay, fantastic. Much better. So on the 10th, you see it kind of came back up above that 27. The spread was looking good, and then there's the huge hit again Tuesday morning, and then it sort of came back up and flirted and then dropped again. Why am I bringing this up? Because we're gonna write all that up for you. We're gonna show you what we would have done here, but that the 7th, when we got into the, when we were talking about it on Friday, the 7th, the stock had just dropped below the 26.96 levels around in this area here. It just dropped below that. And I said I'd wait till Monday, and then we had the huge gap down. But on Monday, it started to pull back up. And then, of course, you see here that we had, I think I'm on the wrong day. I'm sorry, I'm on the wrong days, but that's okay. Because this is what we're doing. What I would have done, by the way, is with that next drawdown that happens on the 10th of the 11th, I would have rolled down to the 26 put and lowered my return from 11% down to about 6% on the position, but then it climbed back up. And if I stayed in the 27, it would have worked out well, but that moving that one strike down still kept me in a positive position. It didn't threaten the 26, okay? We were safe there. It didn't threaten the 26, and I still would have made a positive position on it, but we'll blog that in there as well. Oh, and Sam just points out here another stock in this this market of CGC and TLRY, NXTTF, but it's he says if anyone is in Canada, you can trade NXTTF, and that's in the same thing as CGC and TLRY. All right, well, ladies and gentlemen, we're at about 5:40 p.m. Eastern Time. Oh, okay. I was just going to wrap up here, but Rhajiv mentioned another comment again. Oh, no, I don't want that. Let me go back. Sorry, folks. This is what I want stock-wise. And, you know, again, I'm sorry, I can't give you any direct advice on any position. Maybe. So Rhajiv says GE just had best trading days with volume. All right, so the volume is increasing back up. The RSI started to go positive. You can see here the MACD had a little crossover. It started to go positive, and it's above the 20-day moving average. This one would not appear in my screen again for a bull put credit spread, Rhajiv, only because I don't think the MACD has been 3 days. All right, it's just been a recent crossover. It hasn't shown its true hand. RSI moved up, and then, of course, it did go above the 20-day moving average. But again, this one wouldn't enter my search criteria. That's all I'm going to say. I'm not going to make any other comment on a particular stock or a strategy on a particular stock. If it's a good idea, I can't do that. All I'm going to say is this would not have come up in my search criteria because this crossover here has not been 3 days. It's only been about 2. So if it continues up, and I'd really like to see it positive above the divergence line, that might pop up in my bull put credit spread screens. GE would not right now. Okay. All right. So all right. All right, so Sam says, thank you. It is great to be in even from Australia on vacation. You're flying out today, actually, back home to the USA. You had a fantastic holiday, just too short. Well, I'm glad you got to enjoy Australia, and hopefully you have a safe flight back, coming back, Sam, with some of the different areas of concern around the Pacific that are starting to clear up a little bit. I know it's way further north than you are now, but the tropical storm there, the one that was close to Hawaii, too, of course, and then you got a couple of them around just one of them's near off the coast of Mexico, going slightly north, I think, on that track too. Yeah, there were actually 8 tropical storms and 2 potential tropical storms on the 9th that were all along the line of the equator there. It was an interesting wide view screenshot. Of course, we're focused on Florence, which we should be. But it looks like Helene and Isaac, of course, or was it Helene and Joyce? I can't remember, but 2 of those are curving north. They may actually hit Ireland in the UK in a week and not come here to the mid-Atlantic or to the East Coast of the United States. So that's just something there. But anyway, yeah, I don't see any other, where I was going at with all this is I don't see any other questions coming in at this time. And Rhajiv, I do apologize. I can't give you any more discussion or advice on GE. I'd also look to see when the earnings are. I know you've already done that. But with that chart, I don't think it would have come up on my screen because it hasn't been 2 to 3 days. And just a reminder that today's material, ladies and gentlemen, are my thoughts on your questions I've had during coaching sessions this week as well, designed for educational purposes, increasing investing performance and options knowledge. Any stocks or options discussed today should not be taken as direct trading suggestions. Options do involve risk and may not be suitable for all investors. I do want to thank all of you for your great questions. Dawn, I'm glad we got to discuss that early assignment, and that can happen. But knowing that you had the spread, remember, even if early assignment happens, the most you can lose is the difference in strike prices. The worst thing you could do, and I know you wouldn't, is sell to close your long call early in a spread and then watching the stock move up and, getting assigned on a naked call, but I know you wouldn't do that anyway.